What up, y'all? It's getting to dividend season, and with the price of stocks so far down in most sectors, there are definitely a few places that deserve some attention, so that's what we're going to talk about today. You're watching Sekidul, and today we're talking about dividend options in December of 2022. Now before we continue, we'd just like to remind you that this channel is meant for general education purposes only, and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investment, it's always healthy to take everything with a fair bit of skepticism regardless of the source, and that includes us. So, for that reason, nothing we say here should be taken as a basis for investment, and you'll have to do your own work and thinking before deciding whether or not taking up a position on any stock mentioned here is in your best interest. Want to know how? Well, if you just scroll down a tiny bit, hit the like and subscribe buttons, we'll do our best to help you figure out how to figure out this game for yourself. And with that being said, let's get to it. Alright, so rather than talk about stocks specifically, I'm going to save some time and talk about a few sectors that are known to pay high dividends and drop a take for them as the ex-dividend date gets closer. And first up we have banks. Now with banks, I'm talking about both traditional and financial. These are the ones that we all know from the big financial groups like Hana Financial, Uri Financial, Shinhan Financial, KB, and Kia, to the more popular investment banks like NH Investments and Securities, Samsung Jungkwon, Mirae Asset and Securities, Daishin, DB Investments and Securities, that type of stuff. Now, on top of Korean stocks generally being traded at a discount, these bank stocks have been traded at a further discount for a number of reasons, which also mean that their yields have generally been outsized compared to other stocks in the market prior to this situation that we're in now. In any case, I'm going to start by talking about standard banks and financial groups. Now, in an atmosphere of high interest rates, bank stocks tend to do much better than other stocks. And this is because high interest rates give banks the ability to increase the spread between the cost of borrowing and lending, as well as the cost of borrowing from customers, aka savings account rates, and lending into high quality debt like government treasuries. In many cases, rising interest rates occur along with a strengthening economy, which makes debt repayment more likely, but right now that's not really the case. Still, banks have been relatively resilient against the past few months of market retreat, with big hitters like Hana Financial Group and Shinhan Financial Group down only a few percentage points on the year. IBK is up a few percentage points, and Jeju Bank is up a whopping 64% year to date. Though they were hovering around up 30%, it was a little more stable. There has been a lot of volatility over the past few days. The other big listed financial groups, Uri and KB, are down about 10 and 13 respectively, but these drops, though not nothing, are tame compared to the overall market's massive tumble since the start of last year. Still, with strong profitable years and little stopping them in the way of paying out their dividends, these stocks are just attractive as dividend investments as they've always been. Now, the benefit of Korean bank stocks having been so disliked generally is that when the market turns, it just brings the market back down to the level that the banks were already at. Thus, if hunting for reliable dividends in an unreliable investment environment, the big bank stocks really don't look that terrible. One thing to note, however, is that the main worry with Korean banks is their general exposure to a massive debt crisis, which was truly the greatest worry of the market prior to COVID. With the COVID situation becoming normalized, it's tough to know what's in store for the banks who'd already been dealing with a looming debt crisis before the current looming debt crisis. Real talk, the banking sector alone deserves its own video, but to be honest, for the sake of time, I kind of want to get on going talking about investment banks instead. Now, investment banks have been hit a lot harder. All three of NH, Samsung, and Mirae are down over 20%, and Korea Investment Holdings is almost down 30%. This is due to things like a dramatic pullback in the brokerage and bond trading businesses as investors' market activity wanes. There's also an intense chill in the IPO market and a loss to the value of their assets under management. With all of these things affecting their profitability, there's an assumption that their dividends will follow, since firms generally pay out based on their profits and not based on how much they paid the year before, though obviously some firms do take that into account. Now, as an investor personally, the way I would consider these dividends would be by considering whether or not these dividends are likely to drop as much or more than their price in the future. If, for example, I see a company that intends to maintain their dividend or cut it by less than the price has dropped, then that's a net gain in terms of dividend return. Now, personally, I also don't think it's a prudent way to shop for stocks, but when evaluating potential value plays, it's not a bad way of filtering out potential buying opportunities. Now, one sector that I've been watching for a while has been the venture capital sector, because they're in the money business, and a couple listed stocks have absolutely been hammered by the market and may for that reason be worth another look. Alright, so the main firm that I'm talking about is actually Talent Investments, and over the past week or so, they've been flirting with the down minus 47 and 48% year-to-date mark after settling in the sub-2001 area a couple weeks back. This is far below their IPO price from last December when shares were going for 5,800 per. They did take a tumble as soon as they hit the market, but that's what their IPO price was. Now, I know I'm supposed to be focusing on dividends and I'm moving away from them since Dowell Investment is a bit too young to have much of a public dividend history, but I kind of just want to talk about them for a bit because I think we can learn a bit about firms of this nature by looking at them specifically. Now, a big reason for the shedding in their stock price has to do with their large ownership stake in the company Viva Republica, who are the developers of TOS Financial, both of which have shed significant value over the same time. Drops in the market value of stocks tends to have a disproportionate effect on venture firms and holding companies who base their overall asset value on their stock holdings. Unlike traditional manufacturing firms, who usually have a large amount of their assets in tangible assets like buildings, inventory, machinery, and things of that nature, venture firm assets and holding companies base most of their value on their financial assets instead of their real assets. Thus, if you, like I, subscribe to the belief in economic cycles as a fundamental law, you may come to see such firms as being reflective of a double inefficiency whereby the stocks are down because the tide is low, but the intrinsic value of their company as well as the other companies in their fold is making their situation look far worse than it is. That is to say that their asset values are low, making their corporate value low, but if both their firm and their holdings are being undervalued, that's just a double win for you if you were to buy in. Now, I kind of hope that wasn't a waste of time, but I do want to get back to the classic dividend stocks. And one particular standout is one that I've talked about a lot in the past, and that's KT&G. One of the oldest countries in Korea, KT&G is the country's representative cigarette manufacturing company and parent owner of the Korean ginseng company whose brand Dongguanjang you're probably aware of. Now, this stalwart never really recovered its price after it tanked during the pandemic, failing to breach the 90,000 won ceiling in spite of maintaining a healthy dividend, consistent profits, and tobacco market dominance. Now, over the past few days, it's been trading up above the 95k mark upon news of large buybacks, new tech, and a continued strong dividend policy. Also, general wisdom is to not bet against vice stocks, aka tobacco, alcohol, and gambling stocks during a recession or an economic pullback. Addicted smokers, drinkers, and gamblers generally don't quit their addictions when situations get worse. In the case of KT&G, whether it has reached, surpassed, or undershot its fair value is up to you. However, as we started out talking about dividends, KT&G is one of the most reliable payers of their dividends, and I feel like the little run is definitely worth talking about. Another dividend payer, GS Retail, has gone on a little run as of late, but still trades at a very respectable PE, especially if you consider their merger, which we did a video on a couple years ago. Finally, other high dividend payers worth paying attention to outside of the financial sector include LGU+, Sangyong C&E, Handon System, and Orion Holdings Corp., all of whom took gut punches along with the rest of the market this year, but who are expected to pay a regular dividend as they have for years prior. Finally, one thing worth noting is that if you're going to look at manufacturers, it's definitely important to consider the cost of manufacturing and not just their dividend. We all know that we're in a place of global inflation and skyrocketing material prices, so if you're looking at, say, a construction company, maybe take the time to look at their cash flows, their debt, and their planned projects, and not just how much they'll be putting into your account next April, because, I mean, if they're not able to do that in the future and they tank, it's not really worth it to buy right now. Finally, one more reminder that the general ex-dividend date in Korea for most companies is on the last Tuesday of the year, which will be the 27th of December this year. So if you do want to buy any of these stocks or any dividend stock because of their dividend, you pretty much have to buy it before that date, otherwise you have to wait till next year. Anyways, I don't know whether or not you guys are still in the market. I really hope you are, but if not, I hope you hop back in soon, or just, I don't know, live your life. That's it for me. I hope this does something for you. Peace, fam.